The FedLife podcast is presented by Serving Those Who Serve, a fiduciary, fee-based financial planning firm serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of Raymond James. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. And now, here are your hosts. Dan Sipe serves as a branch manager for Raymond James Financial Services and Serving Those Who Serve. Ed Zerndorfer is our guest and federal benefits expert in the space.
This episode of the FedLife podcast, I am your host, Dan Sipe. Additionally, I'm the branch manager here at Serving Those Who Serve and Lee Sipe & Associates. I want to begin, as I always do, by saying thank you. Thank you for taking the time to listen, but above all, thank you for your service to the government, to the country, to me, to everyone. You just don't hear it enough, but you're always going to hear it here. And the other thing you're always going to hear with me here at the Fed Zone is my buddy, Ed Zerndorfer. Yes, the guru is back with us once again as part of our ongoing mission to reach, teach, and serve you, the career civilian Fed. Once again, we're going to follow along with Ed's Fed Zone articles. Be sure to head over to the Fed Zone, fed-zone.com. Ed is pumping out fantastic content every single week there. Every one of them is worth a read. But this also gives us one more way to reach and teach. So today we're talking about something that has been haunting financial planners, accountants, and feds alike for a couple of years, and that is the Secure Act 2.0. Now, most of the conversation on that has been around the new rules for required minimum distribution for inherited IRAs as a result of that. But Ed, you share something from Secure 2.0 that is really, really important, and that's some important relief for folks who might have missed an RMD. Is that correct?
That is correct. One of the provisions coming out of Secure Act 2.0, which was passed back in December 2022, is the fact that the IRS's, I'm not misstating it, 50%, what's called excess accumulation tax penalty. What is the excess accumulation? That an individual who had reached his or her required beginning date, which for many years was 70 and a half, it's since been raised to 73, did not take out enough or didn't take any amount of their RMD. So,
right.
And the penalty would be 50% of the deficit. So if someone had an RMD, let's say of $15,000 and they neglected to take it, IRS will come along and assess a penalty of $7,500. And
you're killing me.
And to make matters worse, that 50% excess accumulation penalty applies every year that you don't take it out. So if you go on forever, so where's I forgot to take it, or I didn't want to take it, whatever the reason is. IRS says, we'll go along with that. We'll just send you a bill each year for $7,500 every year, plus interest. Well, Secure Act 2.0, one of the provisions was they reduced the penalty to 25%. 25%.
Okay, that's better.
And down to 10% if the individual who missed their RMD would take the RMD within 2 years of after missing it. They would say no penalty,
okay.
No penalty at all. No penalty at all. You paid it back in full.
So zero penalty if you catch it within 2 years.
Exactly. And pay it.
Yep. Okay.
The full amount too. So this was relief. This was really a relief. And
by comparison, that's a great deal.
It's a great deal. And I would say that one of the reasons was passed is that in reality, Dan, IRS does have a heart and soul. And in most cases, they did not do that 50% excess accumulation. They did not impose the 50% excess accumulation penalty for a variety of reasons. one of the reasons was it's so confusing. The whole thing was so confusing that they have to take out this RMD. When's it due? What's it based on? How's it calculated? Individual. And they got, and many individuals who did their own taxes were not aware of it. And so the IRS decided, well, this is before Secure Act 2.0. We're going to make things a little bit easier for individuals not to be subject to that penalty. And if they file a tax form with their taxes for the year following them, they missed it. They missed the RMD. IRS form 5329, and give a reason why they missed it. We will definitely consider waiving the penalty. The penalty. Now, I'm going to share a true example about this.
Sure.
An excuse why they missed it. I have a client that do his taxes. He's a federal retiree. He turned 70 and a half in the year 2011. This is after he had retired from federal service. So his TSP, back in those days, was all traditional. He was subject to an RMD for his TSP. In the meantime, he had a separate IRA, traditional IRA. Traditional IRAs are subject to RMD. So the TSP automatically calculates the RMD and sends it to the TSP participant. They do it automatically. In that sense, TSP is great. I always say that a TSP participant, someone who is subject to RMD, will never have to pay an IRS penalty, because what the TSP does is, if they tell the TSP participant in January of the year they got to take an RMD, every year they got to take an RMD, in January they tell the TSP participant what that amount is. They send a notice in January, Dan. If the TSP participant by early December of that year has not taken the RMD, the TSP automatically will send them another RMD or directly deposit that amount in the bank. They do it automatically. I don't know of any other qualified retirement plan. I don't know of any IRA custodian who does that. They do it automatically. Well, getting back to this client, every year he got, starting in 2011, he got that notice from TSP, and he didn't get any notices from his IRA custodian.
Whoa.
So he did his own taxes back in those days. Here's was his thinking. Well, the TSP RMD calculation includes the IRA RMD calculation. I thought. So when he came to me in 2019 to get his taxes done, he told me about this problem, He had gotten a notice from his IRA custodian. He had changed IRA custodians. Have you been taking your RMDs from the IRA? He got a new IRA custodian. He went to a different firm. And he said, I don't know what you're talking about. Well, have you been taking your RMD these years? I said, no, I thought the TSP was doing it for me. No.
Oh, ouch.
So, the firm recommended me, they knew of me, to do his taxes. I explained to him, that's not correct. He said, what do we got to do? We have to go back and take the R&D back since 2011. We're talking 8 years, Dan. Can you imagine what the 50% penalty would amount to? How much he missed? So what I did was, on his behalf, we had to amend his returns, file IRS 5329, giving the reason why he did not take his RMDs from the IRS. And my excuse, what I wrote down on Form 5, because you have to give a reason on 529. Why did you miss your RMDs? So the excuse was total confusion, unawareness of the rules when it comes to RMD. Guess what? The IRS accepted all the reasons. They waived 50% penalty. 50% penalty.
That's awesome.
So it doesn't take a PhD in taxation to write a reason here. The IRS will accept good reasons why, legitimate reasons. For example, illness in the family. I was so occupied taking care of sickly relatives. I missed it. They do have a heart and soul, but you have to file the Form 5329. That's
gotcha.
In order to get that penalty waived entirely.
Gotcha. So let's get back to some of the nitty gritty of the details of the penalty relief provision under Secure 2.0. In reading your article, I noticed that a lot revolves around statute of limitations, or SOL. So walk us through that, because we know if they're taken care of within 2 years, there's nothing. But then you also said there's a 10% and a 25%. So how does that all fit together?
Here's the situation. Let me just talk in general what the statute of limitation is. IRS has a statute of limitations as far as they want to go back and examine your return. Check the items. Maybe something they found something on the return, on your return, that you didn't put the right number, or you missed something like that. IRS has the right to go back 3 years to review your return, through your returns, in terms of any items that might be missing, which would result in an underreporting of your taxable income. Now, when it comes to fraud, outright fraud, there is no statute of limitations. I just want to point that out. Okay, it has to be something.
They can go forever.
You didn't get the 1099. Your bank or your brokerage, your pension plan forgot to send you a 1099. Therefore, you didn't report the income. That's perfectly understandable, and therefore, again, those type of things, 3-year statute of limitations. Now, what this has to do with the RMD as follows: that if you miss an RMD, in reality, IRS has unlimited amount of time to go back to see what you made RMD. Like the example of my client, like my tax client, he missed 8 years worth of RMDs. IRS had every right to go back to 2011, the first one, to get to assess the penalty. Penalty. When it comes to a statute of limitations, we're talking about someone who has filed the form 1040, IRS form 1040. That will run 1040. If someone missed their R&D, that means they didn't include the income.
Sure.
IRS can go back a little over years. So what will start a 3-year limit as far as, such limitation when it comes to the R&D? The answer is the filing of form 5329. 5329. If you do not file the form 5329, there is no R&D when it comes to statute of limitations. You have to file the form 5329. So, effective with the Secure Act 2.0, the law states that if you file the form 5329, starting with your 2022 tax return, there's a 3-year statute of limitations on the R&D. But the Secure Act 2.0 provisions is they did not make that retroactive. It applies to the filing of 5229 starting with the year 2022 and forward. It does not apply to previous years. So what I did for my client, filing the 529 for all those years, in reality, it does not limit the statute of limitations, because those 529s were filed for years before 2022. So
Gotcha.
That's the key thing here. So my advice to anybody who, let's say, has missed their R&D starting with the year 2022, and that would be 2022, 2023, we're still in 2024, you need to file the form 5229 as part of an amended return. Reporting why you did not take your R&D for 2022. Now, by the way, that means that 2021 is open. 2020, the year 2022, if you miss an R&D, you don't have to worry, because remember, under the COVID, the CARES Act of 2020, Congress said R&Ds do not have to be taken in 2020. So IRS is waiving that year.
Gotcha.
So it's something that individuals who are subject to R&D have to keep in mind. It applies to TSP account owners. It applies also to traditional IRAs. You have a qualified retirement plan, 401k plan, 403b plan. It applies to you too as well. Also, it's going to apply to inherited IRAs. Inherited IRAs. The Secure Act 2.0 created a new thing called an inherited IRA, in which someone, actually it was Secure Act 1.0 created something that if you inherit an IRA, a traditional IRA from someone, a parent, friend, sibling, and that person died after December 31st, 2019, and you're not the spouse, you're just someone else, a non-spouse. You have to take money out of that IRA. It used to be you could spread out called the RMD over your life expectancy. That's no longer the case. You have to take it out within 10 years of the death of the IRA owner. Now,
gotcha.
IRS when that Secure Act was passed, they did not really understand how to implement the rule. That was Secure 2.0. Secure 2.0. And what Secure 2.0 stated that if the IRA that you inherited was owned by an individual who had reached their RMD and was taking RMD from that IRA, you have, number one, you have to take the money out of that inherited IRA within 10 years of the death of that IRA owner, within 10 years. Also, you have to take it out using RMD within the 10 years. Sure. If an IRA owner died before their required beginning date, and you inherit the IRA, you still have to take the money out within 10 years, but you don't have to take it out subject to RMD. You can spread it over 10 years evenly, or you can take it all out after the end of the 10th year.
Gotcha.
There's no RMD. IRS made it very clear in this latest Secure 2.0 ruling that, again, if you inherit an IRA within 10 years, an IRA from a non-spouse, and that spouse was a non-spousal beneficiary. You're a non-spousal beneficiary of a traditional IRA, and the owner of that IRA died after the required beginning date. You have to take the money out within 10 years, and it's each year subject to RMD. Now, I'll be coming up with a column in the Fed Zone explaining how that is done, because it's not easy to understand. I will explain it. I think is that if you miss your RMD starting next year, it's going to start next year, not this year. They didn't require RMD for 2021, 2022, 2023, and 2024. But starting next year, you got to take your RMD. If you miss it, you could be subject to that penalty. So you better file the form 5329 if you miss it. Hopefully you will not miss it. I know that IRA custodians, brokerage firms, and so on are going to be on top of this. I know, Dan, you're associated with Raymond James. They're going to be on top of this, telling their advisors, you've got to make sure that your clients understand when it comes to these RMD rules. It's very important that individuals, the IRA owners, inherited IRA owners, attach themselves to advisors who can give them the right advice. You don't want to pay that penalty, even if it's 25%. It's wasted money. I hate IRS penalties. They're not necessary. Someone should pay that. Doesn't have to pay that. Shouldn't. And there are ways you can legally not have to pay that. So please, the best way to do it is be on top of it, and listen to your advisors, financial advisors, tax advisors, and do the right thing.
Absolutely. So it sounds like on the whole, this change from Secure 2.0 in general is a good thing for folks. So if they do have something go awry, either they're able to avoid the penalties or get them greatly reduced. Now, one closing thought, Ed, because I just want to drive it home. You mentioned that this relief only applies to RMDs from traditional IRAs. So if somebody's got an old 401k out there or something like that from which they didn't do it, they're not going to be able to get the relief. Is that correct?
Actually, no. The relief does apply to traditional qualified retirement plans. It's not just intensive hires. So that's reassuring. But the problem with people who used to have qualified retirement, they forgot they had them.
Yes.
And if you're a federal employee and you are a federal retiree and you do have money left over from a previous qualified retirement plan, my suggestion is just roll it into the TSP. You're allowed to do direct rollovers in the TSP because this way everything is under one roof. You know that, like I said earlier, that the TSP will let you know what your RMD is. And that would include, if you roll over the money, all that money rolled over. This way you won't have to worry about missing an RMD because everything's under one roof.
Gotcha. So, folks, the takeaway here is, good to stay on top of your plans and what you need to do with them. And once again, you're giving feds really important information that's not that easy to find out there. So it's really awesome that we're able to provide it through the SWS website and your great articles in these podcasts. So once again, fantastic article. On behalf of all the feds, thank you for being such a great resource.
It's a pleasure.
Well, folks, that's a wrap. We are Serving Those Who Serve. So be sure to hit that subscribe button on either YouTube or Spotify so you never miss an episode. Share it with all your friends, even a few strangers. Don't forget those live webinars every single week. Just head over to stwserve.com. You will see the blue webinar button. Hover over it. It turns red. Click it. You're going to get the whole menu. We've got our core that we do every single month. We've got our electives. If it's not there, send us some. Okay, we'll look into doing a webinar on it. But I think we've got one of the most comprehensive menus out there. And we are not going to be the type of person that says, oh, all you need is 3 hours to cover everything. That's loopy. It doesn't work. So come here first. To all our competitors, I say thank you. Keep copying us, but just be as accurate as you possibly can be. So don't miss those webinars. The guru will come to you, reach you where you are, teach you where you are, and serve you where you are. Sign up for one, sign up for all. Share that page with your friends. They're going to thank you. Don't miss Ed every single week in the Fed Zone. That's fed-zone.com. So even though we talked about it here, go back and read it. It is dynamite stuff. So wrapping up for Ed, the crew at Serving This Serve, and me, Dan Sipe, I will say good luck, Godspeed, and above all, remember, it's your Fed life. Make it a great one because you deserve it. Stay well, everybody. We are out.